Nice to see everyone. Everybody's feeling fresh after Game 6 Oilers victory last night.
Yeah, let's hope we can bring one home.
So what do you think the probability that a Canadian team would not have won the Stanley Cup in the last 30 years?
I don't know that answer.
It's 0.00024%.
Really?
Yeah, no, that says nothing about the quality of the teams or anything like that. But given the numbers, a Canadian team should have won the Stanley Cup in 7 of the last 30 years.
Is that Trudeau's fault?
We'll talk a little bit later in the podcast, things that are Trudeau's fault, but I'm not sure if hockey we can blame on him.
All right, let's get started. Episode 14, Wealth Talk. Here we are. May has rolled over. We're into the summertime months, and we're mostly through first quarter earnings almost entirely. Craig, what do you think about what the market's done year to date, and what's leading the way? What should we be focused on?
You know, all things considered, I'm going to say it's been a pretty constructive year for most asset prices, in particular the equity side of things. That's been the leader relative to fixed income, which has been somewhat muted over the past couple of months. You know, I would probably say that it continues to be a continuation of some of the stories that we've referenced within these podcasts, such as interest rates and inflation, central bank monetary policy, and then I'd probably say what continues to be a bit of a gold star is the resilience of the consumer and the economy. Certainly, we are seeing some data slow down over the past couple of months, but a lot of the recessionary fears that we saw at the end of 2023 certainly haven't materialized, which has got us to, you know, within 1% or 2, in some cases, of an all-time high on the equity market side of things. And you know, if you kind of look at interest rates and inflation coming into this year, there was talk of what I think 4 to potentially even 6 interest rate cuts on both sides of the border. Here we are in the beginning of June, and we haven't seen one. Now we'll see that in a couple of days with Bank of Canada announcement. You know, that's a reflection of inflation that certainly continues to trend in the right direction, but we're still elevated to central bank targets, which is in and around 2%. I think we're still operating in the high 2s in the US. You know, does that mean that the central bank needs to find 2%, the exact number, to start cutting interest rates? No, I think they're just looking at the trend. Last week we saw some of the data of the US, which is the US central bank's core indicator, which is the PCE indicator, and again, it continues to trend in the right direction. What's keeping the economy resilient, I think, is the strength in the labor market. We've talked about that extensively throughout this podcast. Certainly, you're seeing job hiring slow down, and expectations for job hirings going forward continue to be muted. But overall, I would probably almost say it's like a Goldilocks scenario. It's not too hot, not too cold, which is why asset prices have more or less reflected that as of today.
I agree with Craig, other than I think, you know, you are seeing some signs of weakness out there. I think the Canadian banks who have all reported over the last couple of weeks, their latest quarterly results, you know, sometimes if the Canadian banks or banks in general, you can start to see some cracks, or they start to see cracks emerging before others do, in the signs of some impaired loans, the loan loss provisions they make. So if you look last week at some of the earnings that came out, Bank of Montreal is a great example where, although revenue's up, you know, kind of across the board in most areas of their business, their loan loss provisions increased substantially. I think they're up 120% relative to last year. Their impaired loans this quarter are up to $2 billion. So they're really starting to see some, you know, some stress there in their loan book. Across the board with the banks, all banks saw it. Some, you know, had strength in other areas of the business that offset that. Royal Bank with their capital markets division doing quite well. But I think look underneath those numbers, and when you see the banks putting aside more and more money for loan loss provisions, that's a potential sign of things to come, or at least they're seeing a sign of things to come as well.
Yeah, I mean, the Canadian banks in general definitely have their finger on the pulse of the economy as much as anyone. And I think that trend, we thought, or we hoped we had seen the peak of loan loss provisions back in Q4, but it seems like we're still seeing the banks prepare for that rainy day when writing off loans is going to become a bigger and bigger factor here in the Canadian economy. One of the
Yeah,
things
like if you look at Bank Montreal and their actual impaired loans increasing from about 850 million last year to almost 2 billion, it's a sign. Those are true impaired loans, a sign of things that they're seeing out there. And, if you get into an environment where the consumer is weakened because of, rollover mortgages at higher rates, even if you start to see rates on the short end come down, those two factors could stress the Canadian banks, a fair bit. If we see a recession or, a downturn in the economy or the consumer, that has stress on a lot of small businesses, medium-sized businesses. And as interest rates start to come down, and we have a Bank of Canada interest rate announcement on Wednesday, I believe, as interest rates start to come down, that puts stress on bank earnings from a net interest margin perspective as well. So, I don't, going back to Craig's comments, I think that the economy has stood up relatively well despite some of the challenges, particularly inflation and rising rates. But I don't think we're out of the woods yet. I think that, particularly here in Canada, where we have a lot of mortgages over the next few years to roll over at higher rates, I think it's undoubtable that that there's going to be some consumers that find themselves extremely stretched.
Yeah, I think that's a fair point. Not out of the woods yet, and the reason being, you look at, we talk about inflation and interest rates. The bond market is given a different signal, right? You look at the last couple of weeks here, you've seen bond prices rally again, with inflationary data. Again, it's coming and it's trending in the right direction, but it's still sticky relative to where things need to be to see I think a more permanent solution that rates are going to be cut, and you haven't seen that yet. So the further that rates stay high, and the bond market again is telegraphing that, the more pressure that's going to put on the Canadian economy relative to the US economy because of the debt servicing levels that we have here.
On the corporate side, we're starting to see it as well in Canada with corporate bankruptcies increasing, quite significantly over the last year as well.
So is there a possibility then, where we were critical 2 years ago thinking that central banks were late to the game raising interest rates? Is there a possibility here that they're late to the game monetary policy?
I think generally they are, and they'll telegraph that they generally will be as well. I think they err on the side of caution. Right now, I think they still generally have inflation on their mind, particularly in the US they do. So an early cut of interest rates, or a cut, too early, I think particularly in the States, has the ramifications of another pickup in inflation, and we know what that means as well.
Any thoughts on TD Bank's money laundering charges and their kind of disappointing results we saw last week?
It probably, I think, reduces their chances going forward of the possibility of a US financial acquisition going forward. They're probably going to tap the brakes on that until they clear up all those anti-money laundering issues.
Yeah, I think one of the things, they kind of came out and estimated it at their total charges potentially at around $3 billion, which is a big number. But the day that was announced, the stock dropped by almost 10 billion in market cap. So one of those things that has likely already been priced in. And for a franchise like TD Bank, don't want to condone what they've been doing, but likely, and from all accounts, they've kind of cleaned up their act, put better procedures and measures in place to prevent it from happening again, and hopefully can move on from a disappointing saga there.
Your point, Jay, is well taken, that the market cap loss of TD Bank, over the last year on this probe, I think the costs are actually a lot less than that. I think the true costs are about $1 billion. I think as they hire more people on the compliance side, it's estimated to be a cost of about 300 million on top of that billion. And when they saw the market cap declines that they saw, I think it's unjustified. If anything, probably an opportunity. But that being said, when we see banks go through, some PR issues like this, Wells Fargo was another one, not from an AML perspective, but a marketing problem they had. Bank can remain in the penalty box for a year or two as well, as people decide to put their money elsewhere. But I think it's I think it'll be an issue that we look back in the near term and it will be in the rearview mirror.
Yeah. Now, one thing you mentioned there is market cap, and look at the 2023 story, which was all about the Magnificent Seven, the mega cap companies out of the US. One thing that we haven't mentioned here, not only have you continued to see pretty good earnings coming out of the mega cap, you've seen that broaden out, and I think now that we're officially through first quarter earnings season, I think it's 78% of companies that report in the S&P 500 beat expectations, and 61 or 62% beat sales expectations. So corporate America is actually doing okay. And you, as I said, you're starting to see that broaden out from not just the mega caps. You're seeing that in some of the mid and small cap companies as well that are doing okay. Again, not specific to the US, but that's helping drive equity asset prices as well.
And let's not forget the one elephant in the room, NVIDIA, which is continuing to suck a lot of oxygen out of the market, and their numbers are just incredibly impressive. NVIDIA is the company that's producing a lot of the hardware that's required for the big surge in artificial intelligence and all the computing power that's required with that. Pretty impressive. On a year-over-year basis, they produced a revenue growth number of 260%, so justifying their incredible ascent in that stock price recently. So a lot of good stories, kind of a lot of good themes going on. I think the year-to-date kind of summary of what's going on in the market. Equity markets continue to, like you said, Craig, kind of exhibit this Goldilocks scenario where inflation is moderating, the economy is still doing good enough, and we're seeing some positive returns so far, with the caveat being the fixed income market, which actually continues to express some negative returns, unfortunately. So we need some actual interest rate decreases, I think, before we see some more positive performance on the bond side of things.
Just to take a step back on NVIDIA, and 260% increase over the last year on revenue, I think it was. Does that justify that company moving to, I think, second largest company in the States, and a market cap greater than the entire market cap of the German stock exchange and also the Canadian stock exchange? We've seen similar stories in the past, but I think it's just a kind of a cautionary tale that the growth that we've seen with a company like that, who's been had a dominant market share over the last year and a half on these products. I think the market gets ahead of itself, extrapolating that growth and that market share will continue almost into perpetuity. I think that's just something for people to look at as well.
Well, it certainly wouldn't fall into the category of a value stock. It certainly wouldn't fall into the category of a GARP or a growth at a reasonable price. So I would say that a lot of the performance as of late is momentum based, and we know that can last a lot longer than a high valuation argument can last. But when momentum can go against you, you can see how you've seen it in the past, how quickly you can get some profit taking and a pretty significant decline in something that has valuation of where it's at, and you sit back and go, well, it was trading at 85 times earnings. Why didn't we think it was expensive? It was.
You got to be pretty brave buying it here at these prices.
And there's comparables in the past. If you look at Cisco on the hardware side, in the late 1990s with the build out of the infrastructure, they really had the dominant market share in that hardware that was needed at that time. The significant growth as the internet got built out, that was extrapolated into the future. I think since then, Cisco's had a stock price return of -2% per year since 2000. Tesla a couple of years ago, an extrapolation that they'd be the only game in town for years, and the EV demand that we saw a few years ago going from zero to where it was would continue into the future. I think that's what the market's doing to some degree with NVIDIA as well.
So we touched on the Canadian bank earnings, and I think some arguably mixed results there, but I think that sheds a little bit of light on how the Canadian economy is performing. So I think we wanted to just kind of dive a little bit deeper into how the Canadian economy is doing. We've been a little bit critical of the Canadian economy on recent podcasts, and there's been some numbers that have come out and some data that again raise our concern. So a few slides that we're going to put up that kind of express this sentiment.
Well, while you're bringing that up, yeah, I think you made a great point there, Jay, that if you look at Q1 GDP here in Canada, it came in at a 1.7% annualized growth rate. Not only that, but Q4 2023 was revised down. So, relative to the GDP that we're seeing out of the US, we continue to see, a divergence in the wrong direction here in the Canadian economy. And I think, Clark, you mentioned it, with, the next few years going to be challenging for Canadian banks and specifically Canadian mortgage market. I think that presents more challenges over the next 3 years if we want to see GDP growth above 2% here in Canada.
Hitting on that is this chart that RBC put out. It's the Canadian GDP per capita relative to the US. And going back to 1991, you can see for the longest period of time, Canadian and US GDP per capita trended with a very high correlation. So as the Canadian economy and US economy continued to grow, the per capita output, so per person output of the economy, continued to grow almost in lockstep. And that correlation really broke down back in 2015. Why this is important is that it really kind of speaks to the individual performance of workers here in Canada. So it's a loose proxy for productivity, but it also has some correlation to, not so much quality of life, but the economic output, which means something in every worker's life here in Canada. And we've really seen this divergence over the last 10 years. And as you can see in the most recent years, US GDP per capita has continued to increase, and the Canadian GDP per capita is really rolled over and now actually has a negative slope to it. So curious what you guys attribute this to, and what we can take away from this.
Divergence started in 2015, Jay?
Thereabouts, 2015, 2016.
Was there not an election that year?
There was a
Well, as I always say, it's political people in power politically it takes some time to have some impact on the economy. So I think there's maybe some things that were happening in 2015, namely the price of oil collapse was definitely something that can't be discounted. Is the Canadian economy, is, whether we like it or not, is still very dependent on the price of oil and natural gas, and 2015 was really when it rolled over in a big way, and that was certainly what kickstarted this trend. But there's many other factors, I think, which we can get into.
Yeah, there's a lot going on behind those numbers in that chart. I think, that chart's really two things. There's a numerator and a denominator, the numerator being GDP and the denominator being our population, or the number of workers. And if you tackle both those things, the GDP, we've talked about that a fair bit. I think your comment there about oil prices, Jay, is correct. If you look back, we did see some divergence in the earlier periods there between the Canadian and the US, and then they started to become a lot more correlated in the late 1990s all the way up to 2014. And that was a period of significant demand from China of natural resources. And it was also a period of high oil prices as well. And both those things came to an abrupt end in around 2014, 2015. So I think that's a lot of what's going on there on the GDP side. But, look what's happened since then is that you would expect on that side, with natural resources picking up in the last few years, that we'd pick up with it. And we haven't. And I think that goes back to the political argument. It's a lot tougher in Canada these days to produce those goods, export those goods, than it was in the late 1990s, in the 2000s. On the number side, or the denominator, we've increased our population significantly through immigration. And as we talked about in previous podcasts, generally, a less skilled worker, and that's been weighing on productivity. Other things have been weighing on productivity as well. And you put those two things together, and I think that's really why that chart looks that way. And what's more concerning is the direction right now when kind of the rest of the world is increasing, particularly the US, and we're seeing that decline quite significantly.
Yeah. Yeah, I think the key word there is productivity, right? If you use the example, let's say, of a farmer, 50, 60, 70 years ago, a farmer would work his land by hand, et cetera. Nowadays, equipment and technology is used. So for the same hour of input, the productivity is increased because of technology. But nowadays, if you're using the same technology, you're not increasing your productivity. And I think that's where Canada has stalled. In particular with technology, you look at the US over the past 10, 15, 20 years, we don't really have a leading technology sector in Canada. I think that's a huge contributing factor to the US outperformance. Clark, you mentioned jobs, the quality of jobs that we are bringing on board. They're not highly productive jobs based off of this data. I think some of the other barriers that we have that can improve productivity is the interprovincial regulations that we have. Whether if it's wine going from BC to Alberta, whether if it's resources that are moving across the country, we don't have a supportive network that can increase productivity. So you got a lot of these headwinds that, as you talked, not only started 10 years ago, but I think they've been entrenched in the Canadian economy for a while now.
So I think looking at this in some different ways over the last couple of years, we got this next slide shows one of the policies that was quickly brought in by the Liberal government that remains in power is an increase in tax rates. So on the income side of things, last podcast we talked about the upcoming changes in capital gains tax rates. So again, increasing tax rates, and for those that maybe thought that our last podcast was not something to be overly concerned about, but back in 2016, the Liberal government increased the top marginal tax rate to 53.5%, making it one of the highest tax rates in the in kind of the G7. I have to believe that is one of the factors contributing to Canada's underperforming economy. Taxes do matter, and with the recent changes to potential capital gains taxes, this is only going to further make us uncompetitive and likely add to the frustration that we see as we continue to underperform the U.S. economy.
Jay, I think what you're showing here, you had mentioned these are 2016 numbers, tax rates.
Yeah, this is the change in 2016.
Yeah. Now, since then, both France and Germany have reduced their top marginal rates to 45%.
That's right.
And Italy's down to 43%. So we are, by far the highest amongst the G7. What's more important there is the direction of change as well, where you're seeing some of these other countries become more competitive with tax rates. And with us less competitive, we've stopped increasing income tax rates, but we're now getting tax from other sources as well. And as a result, becoming far less competitive from an international perspective.
Well, we have the benefit within our business, in particular, the three of us being cross-border licensed. So we work with both clients in the US and Canada. And I think we can all agree that the conversations that we've had more recently is about allocation of capital, and not specifically asset class, but demographic allocation of capital. And, I'll speak to the client base that we deal with. I've had more inquiries or just questions around, where can we be more competitive, or where's the best use of our capital? I still think it's home here in Canada, but the fact that those questions are coming up because of the tax rates that you've mentioned here, Jay, because of the ongoing target on the back, capital gains inclusion rates changing here in the next couple 3 weeks. That's certainly a change in trend and a change in conversation that we've had in the 20 plus years that I've been in the business. And you guys feel the same way or seen similar conversations?
Yeah, I think what we are seeing in some of the conversations I've had with people, and we've seen it out there in the media as well, is that if you are a business owner, you're a highly skilled person, you know what, chances are you may start to look at a different environment to work in. And we talked about this on previous podcasts as well, you know, moving to the state of Texas, some young tech workers. On the flip side, you know, when we talk about, you know, our increase in population and the productivity issues we have with lower skilled workers, they may be more attracted to Canada, where a lot of those high tax rates have gone to more social payments by the government as well. And I think, you know, that goes back to that last graph there, and it's a problem that without a solution, you know, I don't see getting a lot better.
Mm-hmm. Well said.
Yeah.
Yeah.
And unfortunately, it's becoming, and I think we're always, at least for our Canadian-based clients, we're always going to have a bias towards the Canadian economy and the Canadian market. And there's a lot of reasons for that, but it's becoming increasingly difficult to justify that from a standpoint of where's your money best put to work, right? And hopefully that we can see some change towards that, but I think it's worth highlighting the things that we're kind of looking at here. So another component that I think is worth pointing out, or a potential influence to that lagging Canadian GDP per capita. This chart really shows where employment gains are coming from within the Canadian economy. And it's pretty clear that since COVID, the majority of growth in the Canadian workforce has come from the public sector. So government employees continue to account for the majority of job gains. At the same time, self-employed, which are in large sense are entrepreneurs, continue to flatline, and the private sector, while increasing, has not increased to the same degree as the public sector. And I think this is something that we really need to be concerned about, as government workers continue to displace private employers. So curious to get your thoughts on this one, but again, another contributing factor to, I would argue, Canada's disappointing economic performance.
The only comment I'd make is that's not a graph or a chart that represents a healthy economy or a sustainable economy.
In particular, small business should be, you know, the meat and potatoes of an economy. And certainly you see that support in the US, and chart says 1,000 words there.
Cool. One more chart that kind of is the other side of that coin, which is recently we've seen a lot of a large increase in the bankruptcies filings of Canadian private companies. We're well above the bankruptcies declared in kind of the COVID 2020, 2021 period. And this is a trend that that is definitely worrisome. So again, a contributing, or not a contributing factor, but another way of looking at the Canadian economy, and kind of potentially reasons to be concerned about what these next quarters and years have for us. But what do you guys make of this chart?
Well, I think that really shows what the Canadian banks have been seeing, you know, on their loan books, and why the increase in loan loss provisions and underperforming loans. You know, the positive I would take out of this chart is that, you know, given the dramatic increase in bankruptcies over the last 3 years or so, maybe that's going to start to peak here. At least that would be the hope.
Yeah. The hope is, again, that policymakers, central bankers here in Canada are paying attention to this data and, you know, act sooner rather than later. As I said 10, 15 minutes ago, if they fell behind the curve on the front side of this, I think the risk day by day, week by week, quarter by quarter only increases the longer that rates stay where they are. And more confidence that, or, you know, telegraphing more confidence that rates are going to start to move lower over the next couple of quarters. The pressure's on, in other words.
So we've got a rate decision on Wednesday that'll be out before we distribute this podcast. What's everyone's call for what the Bank of Canada does on Wednesday?
The market's telling us is that we will see an interest rate cut. I think the market's kind of pricing in the 80% probability of a cut on Wednesday. I think that's, so from that perspective, I'd say we probably get a cut. I think central banks, even the Bank of Canada, where inflation has come down a little bit more and we are seeing some of these soft spots in the economy, I think the Bank of Canada is going to be hesitant to do, interest rate cuts too many too quickly, but wouldn't be surprised to see the first one on Wednesday.
Yeah, I don't know what the stats are right now. Maybe I'll take the other side of the coin. Maybe they give another month of data, but I think they should. Whether they do or not remains to be seen, but we'll find out. I think what you want to listen to is the conference afterwards and see what Macklin has up his sleeve and what their outlook is going forward. If they do cut, what their expectations are for the remainder of the year, and if they don't, the reasons why. What are they seeing that's causing them concern that they need to remain steadfast?
My vote is I think they're going to cut. I think they're going to be looking at the housing data here in Canada, where new construction has ground to a halt with interest rates as high as they are, and as we know, we need to solve this housing problem that we've created from terrible immigration policy. And the only way we're going to start building more homes is by making the cost of capital cheaper. So, as much as anything, I think that's gonna help steer their hand, although they should be not influenced by that sort of thing and only looking at inflation numbers, but we all know that's far from true. So last but not least, President Trump was convicted last week of, was it 34 charges brought against him in the bribery case. We are in an election year. He does face potential jail time, although that's unlikely to happen, as we know. Does this matter? Is this a nothing burger? Do we need to start worrying about the political, U.S. political process and the influence that's going to have on markets as we look ahead to that November election?
Clark, I can see you chomping at the bit. What do you got?
Well, we just switched gears completely from interest rate policy to Trump potentially going to jail.
Both somewhat depressing.
I think a couple things. We've talked about this before. I think we talked about this with Ed Mills on, earlier in the year. Undoubtedly, we're going to see a pickup in volatility towards the election as some of the issues and the campaigning, gets a little bit more heated. We generally do. At the end of the day, does this conviction, really mean anything? You're probably right. He's not going to jail. They started their appeal before this conviction. He can't go to jail before an appeal has been heard. That's going to be heard well after the election. And who knows? I mean, does he become a stronger candidate in those that, in the eyes of those that support him? I personally think for him, it was a win-win, right? If he was not convicted, he could say, hey, I'm not guilty, look at me. And now he can use this as, hey, as a political witch hunt. I think a lot of that support comes out stronger for him. That being said, yes, he's going to lose some support somewhere, but I don't think this is going to affect his support materially. Yeah, go ahead, Craig.
Looking over the weekend, I don't know if you saw some of the stuff that I think the amount of funds that the Trump campaign has raised since last Thursday is in the hundreds of millions of dollars, that even the Trump website, I think, it froze or it shut down because there was so much traffic going through it, and the majority of that traffic was donations to his campaign. So he's already got a strong base, as we know, but it probably just got a bit stronger. Certainly did financially.
I think the other side of the coin there is, what happens on the Democrat side. And, I think on our predictions for earlier this year, the predictions for this year, I went out on a limb, thinking I'd be wrong, but said I wouldn't be surprised if we saw somebody other than Biden or Trump in the White House. And if you're the Democrats now and you see, okay, this conviction, which is kind of what they were banking on, has gone the other way in the sense of popularity has increased potentially for Trump. Do you have a hard conversation internally about the candidate that you're putting in front of Trump in the debates for the next election? who knows? I think that could be the other side, over the next couple of months, to see what happens there.
Yeah, I think that's a good point. I think polls certainly suggest something like that is in order if the Democrats have any hope of competing this November. So I think just to underline our general beliefs in terms of politics, and we want to keep those somewhat separate from how we're investing as long-term investors. And undoubtedly, we're going to see some volatility through the next 6 months here as we get ready for this election, but no reason to change investment policies or move any money in or out of the markets, because we all know how haphazard that can be. All right, well, that was a good conversation. We hope everyone enjoyed it. We will touch base later on this summer with more to come on elections, interest rates, markets, and all that fun stuff. So thanks, guys.
Thanks, Jeff.